Hi people, you want to print out problem 4B4, which I sent you both in email and in your module 3 content. I'm going to take a few minutes here to go over this with you. It will help you with your homework, plus it'll give you some guidance as to the content of the module itself. Now this is a worksheet. It's an informal tool used by a lot of accountants in order to gather up all accounts that are going to be needed in the preparation of the financial statements. The starting point is the trial balance, which is where we left off in Module 2. And if you turn to your textbook on page 157, I want you to read along with me. The trial balance is on that you see in front of you here at 19,280. That is taken from page 158. But if you back up to page 157, the adjustment data in order to finish this worksheet is presented on page 157. So your job is to prepare and finish off this worksheet and then to prepare the financial statements that are based on it. This tool is used by accountants at the period end prior to the preparation of financial statements in order to get all of the accounts needed for the statements up to date, so we'll be delivering reliable information for the users of those financial statements. Of course, you know those users want reliable information in order to help them make decisions. So after having recorded transactions in the journal and posted to the ledger, you know from chapter 2 and 3, you prepare this opening trial balance, which is unadjusted. These figures are not good for the financial statements. So the accountant comes in, snoops around, digs here, digs there, and finds adjustment data that is required. So you establish these two columns. Again, this is informal now. These two columns are simply used on the worksheet to indicate what accounts need to be debited and credited in order to get the accounts up to date. Certainly they need to be journalized and posted to the ledger in reality, whether they're key punched in or whether they're written in a manual system. You've got to prepare journal entries that will debit and credit the accounts as you see we're going to do here in the worksheet. And what you're seeing here is virtually kind of as if we were in the ledger making these postings to the various accounts. So you read the data on page 157. There's the first statement in letter A that insurance expired was $200. Well, many companies, instead of paying month to month, they prepay their insurance. And when you prepay insurance, you're getting future value. And when you get future value by paying in advance like this, you treat that as an asset. But you should understand that if you did prepay in advance, that every month that goes by, or however often you're going to do your statements, for whatever that period is, some of that prepayment expires, which means we need to record the expense associated with the expiration of that cost. And here the accountant determined that $200 of what we prepaid is gone. So we've got to credit out of that asset account to bring it to $4,800. That's the adjusted balance. And we classify all our accounts as to where they're going to go when we do our statements. So there's only $4,800 left in that asset account after we record the adjustment. It's just as if we're in the accounts. We're going to put a debit into the expense and a credit into the asset account. Again, the debit to prepaid insurance and credit to cash when we bought the policy was done previous to this presentation here. So adjustment A, debit insurance expense. This holds true for any prepayment recorded as an asset. As it expires, you've got to reduce the asset and add to the expense, and you can see that $200 goes on the income statement as it's classified here. The second adjustment can give a little bit of a headache because of the wording. It notes in B on page 157 there are repair supplies on hand. That means there's $2,600 left. So that if we had $4,900 of repair supplies recorded, and when they purchased those supplies, they recorded them as an asset, and that there were only $2,600 on hand, that means we have to take out 23 in order for the balance of that account to read what we actually have on hand. So that's our supplies inventory. So I can't write here, but if I would say cost of supplies used, repair supplies available, 4,900, minus what's left, 26. That's going to tell you 2,300. In order to take that 2,300 out to restate the asset at 2,600 bucks. So you got to be careful with the reading there. Guy could have said the supplies remaining in inventory, right, is 2,600, and then you know that if you had 4,900 available and you only have 2,600 left, then the amount that you used up is the difference of 23. You credit an asset to reduce the asset to bring it to the $2,600, as you can see, as adjusted, and then extended to the appropriate column, the balance sheet. Okay? And of course, we need to debit the expense. So we're down here, B, debit supplies expense for 2,300, right? And there's your credit. Now, mind you, again, you've got to punch this into your computer and journalize it and post it so the accounts themselves are brought up to date. The worksheet does not do it for you. It guides you and prepares you to do it. Depreciation in C is on long-term tangible assets such as equipment and buildings and automobiles and computers. What you do is you buy them and they're assets to you, but you do use the stuff up over time. So just like you use up your insurance and your supplies, you're going to be using up your repair equipment. Essentially what is normally done is we spread out the cost of the asset and we expense the asset over its useful life. Now, we debit depreciation expense to record the expired portion of the estimation of depreciation. Again, it is just an estimation. How long is this guy going to live, divided by its estimated life in years or months, as the case may be. Now, the way what you see we don't do is we don't take the 500 bucks directly out of repair equipment, but rather we establish an account called accumulated depreciation, which is classified as a contra asset, C-O-N-T-R-A, which means against. So you can see that if the asset has a debit balance, the contra asset has a credit balance. And when we do our financial statements, you can see this adjustment put in another, there was a credit of 9 there. We put in another 5 to accumulate the total accumulated of 14, and that travels over to the balance sheet columns. And when you prepare your balance sheet, you're going to take that $1,400 credit item and use it as a subtraction against the $3,500, so that the book value, what's left in that equipment on the books, would be $2,100. So that's a bit of a new topic for you, but if you looked at financial statements of real corporations, you'd see the equipment buildings reported net NET of accumulated depreciation. That means they subtract out how much has been written off. The reason for accumulating in a separate account is that we don't want to show the reader that the equipment is down to 3,000 and down to 25 and so forth. We want to disclose to the reader with these major assets that we own, we want to keep the original cost intact. We don't want to write off the equipment account itself. It gets written off via the subtraction of accumulated depreciation. So you got a credit that'll be subtracted against a debit. Where's it done? It's done on the balance sheet, and it shows the undepreciated portion of the asset. Just like we show the unamortized or the unwritten off amount of the supplies, the non-written off amount of the prepaid insurance. Same thing, same general concept, except that we're dealing with long-term plant assets, PLANT, fixed assets. In other words, they're in place for a long time. Okay, so that's C, and then in D, we got some employees who've worked for us since the last pay period, but have yet to be paid for this $180 that happens to end on April 30th. So that April 30th is not a payday, but yet these guys have worked for us, and we owe them 180 bucks. And the theory, of course, is that you record expenses in the period that they are incurred, not necessarily paid. So that if I incurred an extra 180, I got to add it to the 1,500 bucks that was already paid. So the wage expense for the period turns out to be a total of $1,680 after we add the 180 to the previously paid 1,500. Got it? Debit wages expense, and don't forget, if you haven't paid it, you owe it. So we needed the credit part of that entry to establish the liability for wages payable. As you can see, it's dropped in down the bottom here. These four accounts that you see here had to be added on at the bottom of your worksheet. Some worksheets might come pre-printed with the entire ledger, so you don't have to do the add-ons. But if you see a worksheet that has a trial balance without these add-ons, you got to make sure that you add these accounts on and then establish them in the ledger. And you do so by journalizing and posting these adjusting entries. There are four of them here. It ain't going to get no worse than what you see here. So then you'd finish this worksheet off by making sure your second trial balance, which is referred to as the adjusted trial balance, you make sure that those column totals are equal, as you can see, 19,960. And then you spread out the rest of the worksheet according to where the accounts would go. That is, what financial statements will all of these numbers or each of these numbers be shown on. Obviously, the revenues are earned and reported on the income statement. So there's a credit column there, and all of these debit items represent expenses. And of course, if you know what goes on an income statement, you have to just conclude that an income statement is, no matter how it's presented, is going to show revenues minus expenses. And that's exactly what's done here informally. So the total expenses are the total debits, which are subtracted from the total credits, which are the total revenues. And when revenues exceed expenses, inflows exceeded outflows, you've got a profit of 1940, which you plug underneath the 5660 to just simply to mathematically balance the to hello to balance the bottom off, okay? And because the capital account doesn't show the profit. That's why the capital account is short and the credit side then is short by the same 1940. Okay, so we plug the 1940 under the 12,360. The debits are going to be more than the credits because of the shortage in the capital account because it hasn't yet been updated, which you will find in the next chapter, chapter 5. So that's it. I hope this helps you, and I'm going to close this one out, and I want you to hold that worksheet in place because I'm going to go through the financial statements with you. I'm going to I'm going to talk you through the solution. Again, get your solution out and go to the textbook pages and follow along with me. And I mean, I'm trying to give you guys a hand here, so please take advantage of my efforts. Let's see what happens here.